Powell testifies before the Senate, sends markets lower. Here's what you need to know before the bell. This morning, futures are down a smidge, a little bit flat this morning following the Senate Banking Committee testimony yesterday by Jerome Powell, which sent stocks sharply lower as he uttered those words, rate hikes for longer. That is what is pushing markets right now because, again, markets were hoping for this pause by the Federal Reserve, looking for that pause equals pivot, meaning higher stock prices, no recession. Jerome Powell yesterday saying, no. We are going to have to continue to hike rates until we get inflation under control. And right now, inflation is not really showing any signs of slowing to any great degree, not to the degree that we are looking for to be comfortable with pausing rate hikes at this point. Now, the odds of a 50 basis point rate hike in March has jumped to nearly 70%. Terminal rates for the Federal Reserve now up to 5.6%. climbing towards that 6% mark on Fed funds rate. Now, can we get there? Sure, absolutely. But the risk of breaking something in the economy and financially is continuing to increase. And now that risk even is more prescient because of the Fed's actions yesterday. Today, Jerome Powell will be speaking in front of the House Financial Services Committee, second day of testimony, basically reiterating a lot of the same testimony from yesterday, but answering questions. Will he say something else that spooks the markets? It's quite possible. Technically, the markets are sitting right on the 50-day moving average right now. That is a good level of support here. Can markets hold that? That's going to be the big question. It's okay if we break the 50-day moving average because right below that is the 200-day moving average. A second retest of that 200-day moving average, where the 100-day moving average is now also about to cross, is going to be a very important critical level. If the markets can hold that 200-day moving average, that is going to be a very strong bottom for the market, confirming that this kind of bullish trend remains well intact. Now, if we break this level, of course, that is not going to be a good thing, and we'll of course adjust portfolio holdings there accordingly. The MACD still very close to crossing, didn't quite make it yesterday because of the sell-off. We'll see what happens over the next day or so, but be cautious here again. Lots of testimony from the Fed about what interest rates are going to do and inflation. Markets will not like any view of a consistently higher set of interest rates. In other words, the Fed not pausing anytime soon. That is going to weigh on the economy and on earnings growth and profit margins later this year. So continue to watch these technical levels. They're very important. Again, market's done nothing wrong here. We had a nice rally off the 200-day moving average, giving back a little bit of that gain. We'll see kind of what happens next. But we are working through this whole little consolidated process in the markets right now. So we'll have to see what happens next. I'm your host, Lance Roberts, and that's what you need to know before the bell.